Hi, I'm Mike Potter, and I'd like to welcome you to the True Wealth Financial Show, a show dedicated to providing you the information and inspiration to navigate financial decisions, intentionally build wealth, and retire with confidence. I appreciate you taking the time to tune in. Please feel free to like, share, and subscribe so you don't miss any future episodes. Additionally, you can find more information and resources on our website at truewealth.show. And now, let's get on to this week's episode. Hello, and welcome to another episode of the True Wealth Show. Thanks as always for taking the time to tune in. Glad you're here. Great job on continuing investing in your financial future. Today, I want to discuss metrics that matter as it pertains to wealth building. Specifically, I want to address what is a metric, outline 3 different metrics that do matter, and help you understand why those matter. So first of all, what is a metric? A metric simply is a standard of measuring something. So if you think of sports, a score is a metric. Your height or your weight are metrics. Your age or the number of years you've been married are all metrics. Essentially, it's a numerical value assigned to something that you're trying to measure, essentially. So when it comes to money, specifically wealth building, which metrics are important and why? Christ said in Luke 6:38, "Give and it shall be given unto you. Good measure, pressed down, shaken together, and running over, shall men give into your bosom. For with the same measure that ye mete withal, it shall be measured to you again." Peter Drucker said, "You can't improve what you don't measure." So there are some metrics that are important when it comes to wealth building, and that's what I want to address today. Specifically, what should you measure? I have 3 suggestions. Metric number 1 that you should consider measuring as it pertains to wealth building. That is your income. So why is income important to measure? Well, for most people, your income is your greatest wealth building tool. Income essentially is the result of the value that you provide to the marketplace. People a lot of times have this bad connotation towards work, but work is good. Work is valuable. Work is a mechanism in which we obey, glorify, and worship God while also serving fellow man. A lot of people think that work is a byproduct of, Adam's transgression and the curse, but the reality is that in Genesis 2, before the curse, God gave Adam a job. It says in Genesis 2:15, "And the Lord took the man and put him into the Garden of Eden to dress it and to keep it." Adam worked before the fall, right? So this illustrates that work is valuable. And that's how we receive income. So we provide value to the marketplace, value to customers, value to our employers, and in return, we get paid an income. Generally speaking, income increases over time. Most of the time, your decades of your 40s and 50s and early 60s is when you make the most amount of income. Why is that? Because you're more skilled, you're wiser, you're more capable, right? So the more education you have, the more skills you have, the more capabilities you have, the marketplace will reward you with more income because you're providing more value. Think about it. If you're working Chick-fil-A and you make French fries, right, that's good, that's valuable, but not as valuable as someone who maybe does an accounting for a large corporation. While accounting is valuable, in the marketplace, we value a brain surgeon a lot more because they're doing life-saving type of engagements of activities, right? So again, the marketplace will reward us for the value that we provide. So the more education, the more skills, the more masterful of your craft you are, the more value you're providing, the more income you're getting. And so the metric to measure here is how much are you making? What is your income annually, right? So a lot of times when people start off, they start to say, I make so much per hour, so much per week, or so much a month. Eventually, you want to get to the point where you're tracking that annually. And ideally, over time, throughout your career, your income will go up and it should go up, and you should measure that over time. So how much income are you actually making? Metric number 1. Metric number 2 is that of your savings rate. So your savings rate. So how much of that income that we measured in metric 1 are we actually saving or investing? If we're not saving or investing any of it, then it's all coming in, it's all going out, and we're not doing anything with it. So again, income is your greatest wealth building tool, but not if it's all being spent. So you have to build the habit of saving your money over time. What most people do is they spend all their income. And then when something happens or they want to purchase something, they go into debt, either from a credit card perspective or a loan perspective. And that requires them to spend more of their money in their future paying those payments, which puts more strain on your income, right? So you're just perpetuating this thing of not saving money. What we want to do instead is we want to build out a wedge for future purchases and for future goals. That savings rate essentially is the amount that you're saving, either putting in the savings accounts or investments, as well as how much you're getting from a match perspective from your employer divided by your gross income. That is how we quantify your savings rate. The amount of money that you're saving plus the amount you're investing plus your employer contributions divided by your gross income. Historically, on average, Americans are horrible savers. According to the Bureau of Economic Analysis from February 2024, is that Americans are saving about 3.6% of their total income. So not very much. Ideally, you want to be saving somewhere between 15 and 20% of your total income. So the idea is we build out that wedge of paying off debt, getting your emergency fund done, and then we build out that wedge where you're constantly saving over time. In a couple of weeks, I'm going to do an episode, Lord willing, on how financial independence really is a function of savings rate, not income. Years ago, when I was at the CIA, I did a presentation on managing the money that you have. And I had an open icebreaker of that, of all these different athletes from various different sports, various different timelines where they made millions, a lot of times hundreds of millions of dollars of money, but they ended up broke. They ended up bankrupt. They ended up in foreclosure. Why is that? Because they didn't manage the money that they had very well. And the people who would sit there would just say, they'd shake their heads and be like, how could they do that? And then the punchline essentially was, well, you're doing the exact same thing. Over the course of lifetime, you too are going to make millions of dollars. And by the time people retire, they have very little, and they're very dependent upon Social Security and the government to take care of them. Why? Because they didn't manage the money, because they didn't save it, right? So savings rate is an important thing to measure when it pertains to wealth building. The third metric that I want to outline is that of net worth. So your net worth, what you are worth from a value perspective, from a monetary perspective, is you add up all of your assets, and then you add up all of your debts, and you subtract your debts from your assets. If you don't have any debts, you're 100% debt-free, then that number obviously would be zero, and it's just the assets that you have. This essentially is the financial scoreboard. It says whether you're winning or not with money. So a lot of people associate wealth with evil, but it's not evil. Wealth really is just a byproduct of the services and products and the value provided in the marketplace to others, coupled with the sound management of that capital gained from those engagements, right? So that's how wealth is. You're providing value to the marketplace, you're gaining money from it, and then you're managing it well. You're being a good steward of it. And so knowing those two numbers, what your assets are worth plus what your debts are worth, or what your debts value, what your debts total, you add those up. One of the great things of doing this in general is just how much debt are you in? I remember the first time I did this exercise and I saw the total number of my total debts, and it just shocked me. I was amazed by that. So a new segment here we're going to start interjecting to the show is that of utilizing Right Capital. Right Capital is a financial planning platform that I use in my personal practice. And I want to introduce that to you today and show you these metrics inside of Right Capital. Inside of Right Capital, let me first introduce you to Jane and Joe Average. And so this profile here is based upon all of the average metrics that I could find for the average American. So in this case, Joe and Jane are 34 and 33 respectively. They have 2 children, Jimmy and Jenny. This is an overlay of their net worth. The green are assets that they have. The red are liabilities that they have. And the blue is property that they own. From an income perspective, we can see a couple different things here, that Joe works for his state making $50,000 a year. Jane works as an office manager making $34,000 a year. So they have an average income about $84,000, which is the average amount that an average American household makes. So when it comes to income, how much we're making, we can see that a couple of different places in Right Capital. The first one here is on that blueprint, income, savings, and expenses. And so we have the amounts there. Additionally, we can see it in retirement under the cash flows. So Right Capital gives us a year-by-year cash flow as to what is actually coming in, and we can decompose those salaries over time. Additionally, different view, a waterfall view of how much they have coming in and where it's going in terms of various different expenses, taxes, investments, savings, and gives us a breakdown like this as well. So very easy to see metric number 1 of income inside of Right Capital, which brings us then to savings rate, the amount that we're saving. So we can see that as well on our dashboard. And right here, current savings, they are currently saving $6,650. And so that's how much they're actually saving given what they're putting in as well as their employer matches. This too can also be visualized on the retirement savings tab, where we have how much they're putting in today. That was the same metric we saw on the dashboard. How much they're saving in dollars over time, as well as their savings rate here. So they're be saving about 8% kind of going forward. But their average over the scope of their life, essentially, or to retirement, is 6%. So that shows us our savings rate. Lastly is that of our net worth. So on our profile tab, we have our net worth here. Again, kind of calculating assets minus liabilities. If we want to see that in greater detail, we can go to dashboard balance sheet, and we have our total assets minus our total debts, giving us our net worth. Additionally, we can see the details of those in a spreadsheet form, all of the various assets, and those get updated over time, as well as a historical how you've done in the last year as it pertains to your net worth. So that is Right Capital and Jane and Joe Average. We'll be showing you more of these in various shows going forward. As a bonus, I want to give you one more metric that is not important. So when I was going through those metrics, you might have thought, well, what about credit score? Isn't credit score important? Everybody says credit score is important. But I intentionally left that off because really it's not that important. Although a lot of people think it is. Let's unpack that a little bit. According to NerdWallet, the vast majority of Americans, almost 95%, say that having a good credit score is important to them. Well, the reality is that a good credit score does not make you wealthy, right? We're talking about metrics that make you wealthy. A good credit score will make a bank wealthy, not you wealthy. The Ramsey State of Personal Affairs study that they did in 2023 says that the supermajority of Americans, 84%, believe having a high credit score is a sign of financial success. But in reality, it's not. It's a sign that you're borrowing a lot of money, paying back payments, generally with interest. We'll unpack the credit score here in future episodes, but as a preview, essentially, credit score is really an I love debt score. The only way to have a high credit score is to go into debt often, repeatedly, and staying in debt. It's a fool's game, really is what it is. CNBC reports that 4 out of 10 people have no idea as to how their credit score is actually determined, which is probably why they think it's valuable and a good metric to measure. But it's not. It's really an I love debt score, and it's only based upon how much interactions you have with debt. So the higher you score is the indication of the more debt you went into, right? So your credit score is not a metric that you should measure as it pertains to building wealth. Your micro action for the week. Take one of those metrics and determine it. My guess is you probably already know your income, but if you measure it by weekly or hourly, figure out what it is per year. I would recommend you calculating your net worth, something I do for clients every year in the beginning of the year, and you can track it over time. And so this will give you two numbers, how much assets you have, as well as how much debts you have. Seeing that debt number might be a revolutionary, eye-opening experience like it was for me. Today, we talked about metrics that matter as it pertains to wealth building. We talked about what a metric is. I gave you 3 metrics that matter as it pertains to wealth building, showed you where you can find those metrics in Right Capital, and gave you a bonus metric of what is not important. I hope this helps you on your financial journey. If you have any questions or comments, would love to hear your opinions. You can leave them below or send an email to mike@truewealth.show. Until next time, hope you have a great day. Thank you again for taking the time to watch this week's episode of The True Wealth Show. I encourage you to like, share, and subscribe so you don't miss any future episodes. Please feel free to visit www.truewealth.show for more information and resources. One final note as we wrap up today's show. While I hope the information you've been provided has been insightful and valuable for you, it's really for information and educational purposes only. Prior to making any decisions or taking any actions, I'd strongly encourage you to reach out and talk to your legal, tax, estate, or financial advisor who's familiar with the unique circumstances of your situation. Thanks again for taking the time to watch it. Hope you have a great day.